This just in, gold prices have plummeted 8%. This is the largest single-day drop in a decade, triggering massive sell-offs across the board. We have breaking news. Silver has dumped 12.2% and erased $760 billion from its market cap today.
They were staring at their screens, watching their portfolios bleed in real time. Liquidations triggering liquidations. A cascade of red spreading across every market. Stop losses getting hunted. Leveraged positions getting wiped out in seconds. And while this was happening, the mainstream financial media calmly said this was just volatility, normal market behavior, nothing to worry about. But that is a lie. What happened today was not random. It was not accidental. And if you do not understand why this crash happened, you will not survive the next one. I have seen this exact pattern before. Not years ago, not even months ago, just weeks ago. December 2025, the last 2 trading days of the year. Same crash, same panic, same forced liquidations, same fear everywhere. And then something shocking happened. January exploded. Gold surged more than 30%. Silver ripped over 65%. The biggest monthly rally in decades. So the real question is this: is today the end of the move? Or is it the beginning of something much bigger? Because by the end of this video, you will understand exactly what caused this crash. You will understand the hidden force that moves gold and silver that most investors completely ignore, and you will see the historical pattern that could tell us what happens next. And there is something most people will miss: a specific prediction with a specific date, on the record. If you click away before that, you might miss the biggest opportunity this crash creates. Stay with me, this matters. Today is January 29th, 2026. Around 10:30 a.m. Eastern Time, gold was trading near $5,600 per ounce. Silver was sitting at $121. Everything looked strong, momentum was high, confidence was everywhere. Then, 60 minutes later, gold collapsed to $5,100. Silver crashed to $108. $500 erased from gold. $13 wiped off silver in 1 hour. Let that sink in. If you had $100,000 in silver at the top, you now had $89,000. $11,000 gone in less time than it takes to finish a TV episode. If you were leveraged, if you were on margin, if you were holding short-term options, you did not just lose money, you got destroyed. Liquidations triggering liquidations is not a phrase. It is a mechanism. When prices drop fast, leveraged traders get margin calls. They are forced to sell. That selling pushes prices even lower. That triggers more margin calls, more forced selling, more liquidations, a waterfall of red. And the people who bought at the very top, who saw gold at 5,600 and silver at 121 and thought it was only going higher, thoughts and prayers. Now here is what nobody is telling you. This crash did not come out of nowhere. There were warning signs. Clear signals that something was about to break. And let me be very clear, this crash was not an accident. Crashes like this never are. Somewhere, someone knew this was coming. Institutions, hedge funds, big players with access to data you and I never see. They saw the Fed signals early. They saw the China data early. They positioned themselves before the crash. And when it happened, they were ready. They were on the right side, buying what retail panics sold. This is how markets work. The question is whether you keep being the victim or start understanding the game. Gold and silver did not crash because something is wrong with gold and silver. They crashed because of something else entirely. And that something has a name, the DXY, the dollar index. If you do not know what the DXY is, pay attention, because this may be the most important thing you learn today. DXY measures the strength of the US dollar against major global currencies like the euro, the yen, and the pound. When the DXY goes up, the dollar is getting stronger. When it goes down, the dollar is getting weaker. Here's the critical part. Gold and silver move opposite to the dollar, almost always. Gold and silver are priced in dollars. When the dollar strengthens, it takes fewer dollars to buy the same ounce of metal. Prices fall. When the dollar weakens, it takes more dollars. Prices rise. Think of it like a seesaw. Dollar on one side, gold and silver on the other. When the dollar goes up, metals go down. When the dollar goes down, metals go up. They cannot rise together for long. Professional traders know this. That is why they watch the DXY closely, because the dollar tells you what gold and silver are about to do before they do it. Today, the DXY pumped hard. The dollar surged, and gold and silver got crushed. This is not manipulation. This is not a conspiracy. This is basic market mechanics that most retail investors ignore. They stare at gold charts, they stare at silver charts, but they never watch the dollar. Then they get surprised. They call it unfair. They call it rigged. But the truth is simple. They were watching the wrong thing. So why did the dollar spike today? 3 reasons, and all 3 hit at the same time. First, the Federal Reserve. The Fed has turned hawkish again. Hawkish means higher rates for longer, fewer cuts, maybe no cuts. Higher interest rates make holding dollars more attractive. Foreign investors move capital into U.S. assets. Demand for dollars rises, the DXY rises, and metals fall. The market is listening to the Fed. It always does. Second, China. And this one hit silver especially hard. China's industrial data is slowing. Manufacturing is contracting. Economic momentum is fading. Silver is not just a precious metal. It is an industrial metal. Over 50% of silver demand comes from industrial use. Solar panels, electronics, EVs, semiconductors, data centers. When China slows down, traders fear demand destruction. Selling begins. Silver crashes harder than gold. That is exactly what we saw. Third, political uncertainty. The US government faces a shutdown on January 31st. Markets hate uncertainty. After a massive January rally, traders were sitting on huge profits. They were looking for an excuse to sell. Shutdown fears gave them that excuse. Profit-taking accelerated. Risk was reduced. Selling snowballed. Altogether, they caused a crash. Over $6 trillion evaporated in 1 hour. Now here is something most people do not understand. Gold and silver do not move with the same intensity. Silver is gold on steroids. When gold moves 5%, silver often moves 10 or more. When gold crashes, silver crashes harder. That is why silver was up 65% this month, while gold was up 30%. And that is why silver fell harder today. We saw this movie before. End of December 2025. Same crash, same panic, same fear. Everyone said the rally was over, and then January exploded. Now here we are again, end of the month, sudden crash. Same emotions, same pattern. The question is, will February repeat January? Look at what did not change. Central banks are still buying. BRICS nations are still stacking metal. Tether is still buying gold weekly. De-dollarization is still accelerating. Silver supply deficits are still real. Mines are still depleted. None of that changed today. Only sentiment changed. Weak hands panicked. Strong hands accumulated. So what happens next depends on you. If you panic sell, you lock in losses. If you understand the mechanics, you prepare. Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the prepared. Today, $6 trillion changed hands. Some lost it, others gained it. The question is, which side will you be on next time? Because the crash already happened. What matters now is what you do next.